Good afternoon. My name is Adam Farkas. I'm the CEO of AFME, and I would like to welcome you all at this webinar this afternoon. I understand that there's a great interest from market participants, from firms, regulatory authorities, and the media, as I understand that there are more than 600 of you registered for this webinar, and hopefully most of the registered participants are already online. Let me first put this webinar into the context of decisions made by authorities on the US side, and why we are here and why there is so much interest in this topic. As you may well know, in February this year, in the middle of February this year, the Securities Exchange Commission of the United States issued a rule amendment which is aiming to shorten the securities settlement cycle from T+2 to T+1 as of the 28th of May, 2024. So essentially, we are less than 1 year from that date. This decision was preceded by major efforts by the industry in the United States, which was led by SIFMA, our sister organization in the US, who the colleagues at SIFMA coordinated with the Canadian and Mexican colleagues in order to make sure that North America moves in lockstep with respect to this major decision, which has got implications to all of us. Now, if we look at how interconnected Europe is with the US securities markets, both inward and outward, it is very clear, and it was very clear, that this would have significant implications on the functioning of European markets on the way forward. It was the case, we have experience of this, it was the case when the settlement cycle in the last decade was shortened to T+1. So it was not very difficult to see that this would have major operational consequences in Europe. In response to this, and in preparation for this, the UK government set up an accelerated settlement task force, which is chaired by Charlie Gaffin. This task force was set up in December 2022. And AFME, from the start, immediately expressed an interest and applied for a participation in this task force. And we are proud to be part of the task force and part of the core team, which will be drafting and devising the outcome of the work of this task force. On the EU side, there was no, let's say, official initiative from the public sector, from the policymaker side. So AFME and its members decided to go out publicly and issue an invitation for other parts of the industry, other segments of the industry, the entire ecosystem of capital markets, to form a T+1 settlement task force in the EU and start the work on preparing the industry, preparing the markets for the period when the US have already moved to T+1, Europe still remaining in T+2, but also to facilitate discussions on how best Europe could also accelerate its own settlement cycle, eventually reaching T+1 in the continent as well. This work is ongoing, and I think the purpose of this webinar is really to provide all of you who are interested in the information, the accurate information, the accurate details of the consequences of the US decision, the implications this would have on European markets, and also to facilitate the further preparation of Europe to eventually move to T+1 as well on this side of the Atlantic. On this note, my role is really to hand over to Pete Tomlinson the floor, who is leading this effort on AFME's side. And on behalf of him and on behalf of AFME and its members, I would like to thank all of our speakers today who committed their time, agreed to join this webinar, and share their views, their experiences, and their preparations, their respective preparations for this major change in the post-trade environment. So thank you again for registering. Thank you again for participating. and I would like to thank our team, the AFME team, with the lead of Pete, as well as our speakers for being with us today. Pete, the floor is yours.
Thanks very much, Adam, and good afternoon, everyone. We've got a huge amount of material we're going to try and cover in this 1 hour slot. So I'm going to very quickly introduce our expert speakers, and then we'll dive right in. So we're joined by John Abel from DTCC, who of course have been heavily involved in the inception and implementation of the US T+1 project. We have Barney Nelson from the Value Exchange, who've done a huge amount of research on market sentiment and readiness for US T+1. We have my AFME colleague, Pablo Garcia, to provide some more perspective on what we're doing in this space. Emmanuel Rees from BNP Paribas, representing the custodian view. Sachin Mahindra from Goldman Sachs, who's also chair of the AFME Clearing and Settlement Committee, to give the broker-dealer view. And then last by no means least, Susan Yavari from Pharma, to represent the views of the European buy-side community. So John, can I come to you first to maybe kick off with a bit of a factual overview of what the new requirements are, the sort of who, where, why, what, when, and how of US T+1?
Yeah, sure. Thank you, Peter, and then hello to everybody. I kind of start at the end, and I think Adam kind of teed some of this up in the introduction, but the implementation date of T1 in the US is Tuesday, May 28th on 2024. Just as a point of reference, in Canada, the other major market moving to T1 is actually moving a day earlier than the US, so they'll be moving on Monday, May 27th, 2024. And that's because the Monday, the 27th, is a holiday in the US, which is why that weekend was chosen. So that actually makes Friday the last T2 trading day. The Tuesday is the first T1 trading day, and the Wednesday becomes a double settlement day. The date is coming up very quickly. It's not necessarily the date we wanted in the US, but there has been an awful lot of preparation work that was done to get ready. A lot of that information is available for people to look at, to come and view. There are all sorts of educational events that were done by SIFMA, ICI, and DTCC. There's a lot of documentation that's available, specifically an industry playbook, which really outlines all the areas of change in the US, and actually is a pretty useful tool to help firms get organized around their T1 effort. All of this material, I'll point out, is parked in a dedicated T1 website, ust1.org. You can find all this information. Again, it's a great tool. I will say there's 335 days left until implementation. So if you're at the point where you're still kind of getting organized, I would say you're probably late. Most in the industry are really preparing for industry testing. So testing is scheduled to begin August 14th of this year. We have 21 two-week test cycles scheduled in the US. It's a combination of structured tests and unstructured tests. So the unstructured test is kind of free form, come in, push through any types of transactions that you want. The structured test will be more around testing things like holiday processing, implementation date, testing out some of the double settlement dates and some of the unusual dates we have in the US market. We'll also be conducting bi-weekly testing industry calls. So we'll bring together the industry to talk about the previous week's test, what went right, what went wrong, and then to start preparing everybody for the next two-week cycle. Make sure everyone understands what's going to be available for testing. Generally speaking, at this point in time, most firms are working through their connectivity to DTCC to be able to do testing. They're making sure they have access to our test environments. They're making sure they have all the applications and access that they need to do testing. I would say if you're a direct DTC member, this is the time to really start preparing for testing, to start working through your test plans, making sure you have connectivity in place. If you're not a DTC member, certainly work with your custodians, your US brokers, your US service providers to understand what their test plans are and how you can get involved. I think the last point I'd like to make in terms of kind of the the factual overview is we are bringing together we have a T1 industry steering committee, which was very instrumental in the beginning of the project to kind of get us mobilized and help us define the changes and work with the regulators. We're going to reconvene that group leading up to implementation and start preparing for implementation. So I would say there's likely to become more materials coming out of the US targeted around implementation. So keep an eye out for that.
Thanks so much, John. Clearly a huge amount to be done to make this happen. And as you hinted at, the industry didn't quite get its wish in terms of the implementation timeline. So Barney, it looks like there may be some kind of market readiness challenges. What are you seeing so far? How is readiness varying across maybe geographies and different types of participant? Any particular hotspots that we should be concerned about?
Yeah, no, look, thanks, Pete. And thanks very much for having me on the call. I mean, I think exactly as you said, there are numerous hotspots emerging. And I think for me, what's been really telling is over the last few months, as this call evidences really the shift in kind of hotspots across the Atlantic almost, that I think, as John says, I think probably broadly speaking in North America, there's a significant amount of project activity going on. I think in Europe and Asia, to massively generalize, I think we're probably more getting into the zone. So, if I was to just put a bit of put the readiness into a little bit of context, we did an outreach just around the time of the SEC's announcement earlier in the year, which I just want to walk through really quickly, just because I think it's really important to kind of contextualize the European conversation. So first of all, basically readiness obviously is a factor of impact and who's impacted. And I think, in the context of this conversation, for me, what really stands out is the fact that actually, when you look at who is most impacted by the US-Canada move to T+1, it's the people on this call in Europe and in APAC to a large degree. So we'll hear from Emmanuel shortly on the custodian impact. The investor impact it's very meaningful. Not surprisingly, because of factors like time zone differences and obviously currency differences, FX limitations and everything coming in. I think the other key thing is the scale of the organization really matters. There's a lot of basically a lot of manual processes. Obviously, there's probably less sophisticated STP processes going on in tier 2, tier 3 organizations. Those are the guys that are likely to come into a lot of come under stress as we move into a T+1 environment. So in terms of impact, the other way that I just very quickly characterize it is that T+1 sounds like a settlement issue, but I think for me, as we get closer and closer to this, fundamentally, it's a problem that stretches across 7 departments in our estimation, or based on our research across the organization. So it starts with the middle office. It actually really starts with account onboarding and contracting to make sure that you've got the right contracts in place to encourage compliance with the SEC regulations. But the middle office, are the allocations happening on T0? Funding, especially important for investors, linking in the FX piece, but also the whole funding question about managing mismatches with GDRs, managing mismatches with settlement cycles on funds, et cetera, and only then it really becomes a settlement issue. So for me, one of the key things is not to set up the poor settlements team for failure just because you think it's their problem. It's ultimately they're the ones who are being set up for success or failure. And we cannot overlook the critical importance of sec lending and fails coverage, and also corporate actions. All of these teams are impacted, and so it's really key to make sure that basically that the T+1 conversation is an enterprise-wide conversation, not just a quick chat with your settlements person. So a couple of other points, just really briefly. I think to your point, Pete, around readiness, part of the challenges ultimately is that when there are significant gaps in readiness. I think if you look at overall, when we first started looking at this, about 40% of the industry was still kind of thinking about T+1. And to John's point, if you're still thinking about it now, you've got a serious problem. But I think if you look at the levels of institutional investors that need to come into the tent still, in terms of actually moving out of the scoping phase into a project phase, we still have, particularly in Europe and Asia, a large gap, I'd say, in terms of readiness and engagement, albeit catching up, I think, in the last month or so. Why are we struggling? Ultimately, in Europe, it's basically around the cash transactions, broadly speaking. So cash equities, fixed income trades, and GDR trades are far more challenging for Europeans than they are for anyone else in the world. But interestingly, for anyone in Asia on the call, actually, collective investment vehicles, both open-ended and closed-ended funds, are especially challenging, I think, in Asia, largely due to the funding mismatches point that I was talking about, and also the impact that has on valuations. So I think for me, one of the key things that I'm just skipping through, the key things that, there's two solutions to this, which we're going to be able to expand on. One is ultimately what we need to be doing, to get rid of manual processes. Anyone who's still running a manual process around T+1, that's a pretty fundamental starting point. That's the starting point, I think, from an industry perspective. But interestingly, alongside that, dependencies on market providers like sec lending platforms, CLS, and people like that. We are a networked industry, and as a result, we do depend heavily on some organizations to be able to get us there. So for me, part of the T+1 readiness plan is making sure not only that we focus internally, but also externally, but that our location strategy is very directly impacted by this. So you can see that about 50% of smaller European organizations are having to look to the East Coast and West Coast in order to be ready for the time zone differences and the pressures that are going to be put on us. So long answer to a short question, Pete, but I think for me, the key point is that there are definitely hotspots in impact, tier 2 firms, Europe and Asia, global custodians and investors. There's readiness gaps, but ultimately 335 days to go, 334 for Canada. We've got no time to waste.
Thanks so much, Barney. I think you've teed up a lot of what I think we might dive into later in the conversation. Emmanuel, you're based in New York, but looking after a kind of global client base. So from the custodian point of view, do Barney's findings match up with what you're seeing? What do you and your clients perceive as the kind of the key issues to address before next May in 335 days' time?
So first of all, thank you to AFME for the invitation to participate to this panel. So I completely echo with what Barney explained so far. So preparation is key in this project. So as a custodian and participant to DTCC, BNP Paribas New York is preparing for the transition to the T+1 securities settlement cycle. For us, the key element is to operate efficiently in a compressed environment. In this context, we are conducting a healthy review of our technology and all our post-trade processes. As we have only one day less to complete all post-trade tasks, we focus on automation, as Barney mentioned, and removing manual tasks that may remain in the process. We are looking to all the point of friction, and we are finding solutions to remove them. So the technology review include not only the custody platform, but also the downstream and upstream system to ensure smooth and timely flow between the systems, and also to make sure that all pre-settlement controls must continue to be correctly performed in this new compressed timeline. So we already know that the change in the custody platform are more or less limited to change of schedules due to the new cutoff. Because if you think about it, the change from a system perspective, it's similar to the change that happened in 2017 when we changed the settlement cycle from T+3 to T+2 settlement. So from a system perspective, the custody system are ready to cope with that change. So now the next key milestone, and as John mentioned, is for the global custodian and DTC participant to start the industry testing in August 2023. So that's for our preparation so far from a custody perspective. But another key element to a successful transition to T+1 for us is the readiness of our clients. That's why client communication and client readiness are key pillars of our project. We have focused so far on client communication, client presentation, webinars like this one, and preparing materials. As the US market is the largest market in the world, the impact is broader than US and Canada. It definitely affects international clients because every investor holds in its portfolio US securities. So there are huge ramifications. So from that perspective, it's very important for global custodians to understand their client behaviors, to investigate the area of inefficiencies, and to propose solutions available to help them in their transition. So far from a client perspective, especially from cross-border clients, they raised a lot of valid questions and concerns. First of all, of course, the time difference, which will trigger most of the problems. The new cutoffs are very challenging for international clients. The new allocation or affirmation cutoff are respectively at 7 p.m. and 9 p.m. on trade date Eastern time, which, if you think about it, is the middle of the night for the European client. So the processes like FX, funding, securities lending are becoming much more complex to be achieved in this shorter time frame. The client must review all their cutoff with their provider and adapt to them. The international client may want to review their operating model. They may think about moving their back office or middle office team closer to the US execution team in the US. Or they may think about working during US hour to have work shift during the US hours. Clients, as part of the review of their operating model, they may think about using technology enablers or industry solutions to facilitate their operation in the T+1 environment. They will definitely have to review their exception management process for a quicker turnaround of unmatched transaction. And finally, there are a lot of questions about misalignments among markets that are also raised by the clients. So in a nutshell, from a global custodian perspective, those are the questions that we receive from our international clients.
Thanks, Emmanuel. Maybe turning to Sachin then for the broker-dealer view.
Thank you very much, Peter, and thank you to AFME for having me this afternoon. So yes, from a broker-dealer perspective, share a lot of the points that Emmanuel raised earlier as well. And also Barney's presentation was a very great insight into what the rest of the industry is experiencing. And there clearly are a number of common areas of overlap and areas that need to be focused on. Specifically from a broker-dealer view, we have also been engaging with our clients who tend to be the asset managers, hedge fund clients, etc. We are starting to see that the awareness amongst this client base is increasing over time. So I appreciate, Barney, you did your initial surveys earlier part of this year, but we've actually been able to see an increasing amount of awareness and understanding of the changes and a level of acceptance that this is now coming and we do need to work towards it. So that's certainly a positive thing to see. Now, that doesn't mean that there are not challenges ahead that we need to figure out how to resolve. One thing, having a look at the results from Barney's presentation, I was surprised to see back then that the middle office and the FX components were not as high up on the list than they are probably going to be today if you were to rerun that analysis. The reason I say this is because whilst we are compressing the settlement cycle, the focus tends to be naturally on settlement, but actually what we are compressing is the post-trade processing time between trading and settlement, which essentially is what we loosely term as the middle office processes. And where we have the compression, and I believe, AFME, we've previously made statements on this about the compression being almost 70–80% in post-trade processing time, that's really where I think there's a real need for increasing STP and efficiency. At the same time, we're starting to see that FX is becoming more of a concern around access to liquidity at certain points in time. So clearly there needs to be more work to be done to look at what solutions will be in place for that. And that's exactly, I think, what we need to spend the next a few months looking at. So I think the focus really for ourselves is to look at the root cause solutions rather than looking at the resulting problems. It's not necessarily about fails, but let's try and avoid those fails by looking at upfront where we can solve some of these issues. Now, the global impacts are interesting. Obviously, the suggested timings for allocations and affirmations, and I think, again, Emmanuel pointed this out earlier, is that, for European firms, we'll be literally right in the middle of the night. For Asian-based clients, potentially in Tokyo, Hong Kong, you may just be able to catch the end of the US business day at the start of the next their local T+1 day. So actually that can be resolved. In terms of what we are looking to do right now as a firm, we are really strongly looking at T+1 to act as a catalyst for some positive change in the post-trade space and identifying areas where we currently have inefficiencies with our clients and ourselves, and resolve those issues using strategic STP channels. We are also obligated under the rule, which we'll come on to later on, which is 15C62, where the broker-dealer either needs to enter into written agreement or have policies and procedures in place to ensure that their clients are complying with the same-day allocations, confirmation, and affirmation requirements. So one of the key areas for us right now is defining what are the terms of these policies and procedures. How do we as an industry come up with a common set of policies and procedures, and something we're working with AFME's sister organization, SIFMA, to understand better. And I think it's important that we use that opportunity to come up with a consistent and harmonized approach as much as possible. Equally, at the same time, we at Goldman Sachs are doing an outreach with our clients, at least creating the awareness, making sure, whether it's through AFME today here, or direct webinars and publishing materials, live meetings, or even direct engagement. So we're using the data to tell us where the hotspots are and who we need to speak to first, and what types of business flows need to be engaged from the beginning. And finally, I guess the other areas I'll just touch on just right now in terms of the core focus areas for a firm like ourselves is looking at some of the open issues that we still see with the misalignment of security settlement cycles. So this is predominantly an issue when we are looking at security types such as ADRs and ETFs, which have a global international component to them, where you may have one leg settling on a T1 basis and another leg settling on a T+2 basis. And so there are ongoing discussions right now in terms of working out what is the best way to mitigate some of the balance sheet and capital issues that may cause, as well as some of the more transactional buy-in type of challenges that cause under the Reg 204 regime, where there could be a buy-in on an ADR, which is dependent on a conversion of an ORD, which is settling on a T+2 basis. So whilst we don't have firm solutions to these, the idea is to actually end up in a position over the coming months to actually define and solve for these problems across the industry. And this is what we're making sure that between ourselves and our clients is being proactively discussed and engaged. The final point I'll just make there within that is the FX challenges. So that, like I mentioned earlier, that's becoming more of a hot topic. And so understanding how we can work with FMIs, service providers across the street, buy side and sell side, to make sure that those issues can be remediated.
Thanks, Sachin. Susan, so I think both Emmanuel and Sachin have kind of talked about client outreach as being a key part of their work, and there's this sort of perception that there's going to be significant impacts on the investor community. So from the Afama view, how are your members preparing, and what do you see as their priorities for next May?
Thank you, Pete. Thank you, AFME, for the invitation to be part of the panel today. And yes, I have to say that I definitely related to Barney's presentation, where you were showing some kind of red color when it came to the investors. But also I can echo some of my fellow panelists when they said that there has been a shift. There's definitely been a shift in the last few months. So we're definitely I don't believe that the awareness, and we certainly weren't in an implementation mode in the last few months, but I think we've done a fair bit of a journey now, and I think we are very worried. So we're aware and we're worried is how I would qualify buy side currently. In terms of the key challenges that we face, again, I think Sachin and to some extent Emmanuel also alluded to those. So maybe I'll just give you a quick kind of flavor of what perhaps some of the top priorities are and top challenges. Of course, they relate to the settlement mismatch of US on T1 and EU on T2, whether it's funds or ETFs, with funds settling, whether it's redemptions or subscriptions on a T2 basis, but these securities that we hold are settling on a T1 basis. So there's a funding gap there, which I think there are a number of ways to address, all of which, of course, come at a cost. But if we look at the funding gap, you're going to look at overdrafts, credit lines, and again, in a higher interest rate environment, I think it does begin to look like a significant sort of cost line for us. Pre-funding, of course, is another option, but again, there's performance drag there as buy side having to accommodate EU T2, US T1. Equally, I think something perhaps that people may not be aware of, but under UCITS rules, we have limits as to how much cash we can hold in our funds. And again, due to this mismatch, we may have, on the one hand, we may have shortages of cash where we're having to fund positions, but equally the reverse is also possible, whereby you have funds flowing into the fund and you are not settling with the investor for another day. So you're sitting long on cash for a day, and that's going to cause a breach with European regulation. So that's something we have to look into as well. Then I would just really echo what's already been said in terms of having to build out operations. So either run night desks here in Europe, or if you're lucky enough to have US operations, then extending staffing there, especially to the points that Sasha was making around the trade matching and affirmation, so to be able to kind of resolve any settlement instructions and any errors there. And then the final point, I know we're going to talk about FX lending as a standalone, so I'll probably park that for now. But on the securities lending, that's definitely an area that's kind of come up as a major challenge as well. And I think there we're not very sort of far removed from what I understand the US industry is also kind of assessed around a move to T1, which is there may be contraction in securities lending because of the difficulty of recalling stocks in a much shorter time frame. Again, for us, not to be a bore, but it presents a performance drag, right? The fact that we're unable to loan out our securities. So yeah, in a nutshell, that's kind of the issues that we're looking at. And yeah, I think if there's one thing that's true, and that's why it's great to see this very broad panel, is that there's going to be a lot of conversations that need to happen between us. And yeah, thanks.
Indeed, thanks. So I'll just note, I've neglected to mention there is a Q&A function. So if the audience have any questions that you'd like to pop in, please do that, and we'll do our best to answer them as we go and at the end as well. So kind of summarizing those views so far, it's, I guess, at the risk of oversimplifying, there's kind of 3 core processes that need to happen to facilitate settlement. You've got the sort of matching and placement of the instruction, you've got the seller making sure the securities are available, and the buyer making sure the cash and the funding is available. And there are issues in all 3 of those areas. So maybe drilling into that first one a little bit more. Sachin, and then Emmanuel, what do you see as the kind of main obstacles and potential solutions towards ensuring that timely matching and placing of instructions? Sachin, you mentioned the new kind of requirements in that area.
Sure, certainly, Peter. So as mentioned earlier, the SEC final rule 15C6.2 states that the allocation, confirmation, and affirmation have to be completed as soon as technologically practicable and no later by the end of the day on trade date. So it's basically that means as soon as you can on trade date. I think it's important on this call, this session today, to define what we mean by allocation, confirmation, and affirmation. I think the term allocation is pretty well globally understood as the allocations that the asset manager provides to this executing broker to make sure the order that's been filled is allocated to the correct funds. So that is a consistent process, and we've referenced that several times on this call today, and that timing is now set to 7 p.m. Eastern time. It's also important to note that whilst the SEC basically says all these processes have to be completed at the end of T0, these times of 7 p.m. and 9 p.m. have been set by both the industry and DTCC as the most practical times for these processes to occur to allow the sufficient overnight processing batches to run. So we end up having a 7 o'clock allocation deadline. Now, the confirmation process is actually the process by which the executing broker sends a trade confirm to either the client's global custodian or their prime broker using a platform called Trade Suite ID. And the affirmation process is either that global custodian or the prime broker affirming that trade confirm. That's a very unique process to the US and shouldn't be mistaken for any sort of matching processes that we have here in Europe. And so it's important to understand for those on the call, if they are doing confirmations and affirmations themselves or having third-party providers doing that and understanding how to resolve for those and making sure you can track and measure yourself against it. The timings, as also mentioned earlier, are very difficult for European-based firms because that 7 p.m. allocation cutoff basically means midnight here in the UK, 1 a.m. Central European time, and the affirmation deadline of 9 p.m. equals 2 a.m. London and 3 a.m. in CET. So clearly very odd timings for us to be working. So as much as we've talked about potential opportunities for certain types of institutions where it's possible to move operations close to the US time zones, there are also other automation opportunities available. And I'm sure maybe John will talk about it at some point, but there's a solution known as Match to Instruct, which allows the affirmation allows the allocation at 7 p.m. to automatically affirm and be ready and be compliant with that 9 p.m. cutoff as well. That's available to some institutions for certain types of flows, but certainly another area for to be explored and looked into. But I think the key thing here really as a recommendation is rather like CSDR, which I'm sure many on this call are familiar with. We can use also data in this context to drive the decision making and prioritization of what we do, to understand what allocations and affirmation rates are today at those respective timeframes, and therefore understand which business flows, which clients, brokers, custodians, counterparties are not going to be compliant come 28th of May 2024. So definitely using data to drive decision making here is a useful tool. I think, Peter, you might be on mute there, but I think Emmanuel probably
pulled me out. Yeah.
No, I mean, I think Sachin, you highlight in detail what is the new context and the challenge on trade data, because the investors, the clients have a very short time frame after the close of the stock exchange at 4 p.m. and the 7 p.m. time frame for allocation, and later on the 9 p.m. time frame for affirmation. So I think the client will have to think about the way they will send. They will, send the allocation to the broker, send the transaction to the custodian for affirmation, or think about a new model with self-affirmation or solution. As you mentioned, the Match to Instruct solution from DTCC. So those are the considerations that the client will have to think about, because ultimately what is very important to have in mind is the fact that we want to settle most of the transaction during the nighttime cycle of DTCC for two main reasons. First, because transactions that are matched have less chance to fail on settlement date. And second, if we want to compare to Europe, in the US, there is no penalties per se for late settlement, but the cost of settlement differ if you settle during the nighttime cycle or during the daytime cycle. And so obviously, we all want to benefit from a lower cost and settle the transaction during the nighttime cycle. So that's why I think matching this affirmation cutoff will be key. And that's why the model will have to be reviewed. And that's why the connectivity and communication between the buy side, sell side, and custodian throughout the trade cycle will be essential.
Thanks, Manuel. And you mentioned that difference in cost between, depending on what time of the day or night you settle in. John, maybe could someone outline the difference between those two costings? Does anyone know?
Yeah, I mean, it's significant. And I don't know the exact numbers, but it's kind of somewhat staged. So obviously, if you process the transaction, through the intended flow with the affirmation in ITP and having it handed off directly to DTC, I think it's 4 cents to each side. Then there's the ability to introduce it for trades that don't get affirmed. They can be introduced directly into the CSD for settlement. If they come in during the night cycle, it's more expensive than the ITP flow, but it's less expensive than if they come in during the day cycle. And that's where I think the real increase in fees is that change from ITP to the day cycle. I think that could be impactful to members.
Thanks, John. Susan, when we're talking about this, the cash leg, you alluded to the impacts already on firms' funding models and sort of the related processes like FX. Do you want to maybe elaborate on that a little more?
So that's definitely another priority area for us. How do we access US dollars in this compressed time frame? And I think if under T+2 we had something under 48 hours, now we're looking more at a 6 to 8 hour window, depending on when you're actually trading, in which you have to source your FX. But if your trade comes late in the day, as some people have pointed out, markets close at 4. That leaves you about an hour where the FX trading desks are still open, and you can look to strike an FX. So it is very much compressed, and I think it's a time of day where liquidity is already thin, and you could probably expect to have more directional sort of FX trades coming through. So it all points to kind of less attractive environment in which to source FX. Sort of the various possible solutions that we're looking at. One is sourcing the FX to the custodian. So there's a convenience factor there, but equally, I think ideally we prefer to have competitive rates, so really be out in the market and not constrained to our custodian. The second piece is if we do a non-standard settlement, because through the CLS, of course, there's a cutoff times, and if you're going to miss those cutoff times, then you're basically required to go for a non-standard settlement. In which case, then you lose the benefit of clearing your FX on CLS and having that counterparty risk management. And then, of course, there's always the option, as we saw previously, of pre-funding, but again, that comes at a cost. So yeah, it's one of our major issues that we're still working through, Pete.
Yeah, it's still in the state of sort of identifying the challenges. Yeah. Pablo, anything to add from an AFME perspective there?
Sure. Hello, everyone. Thanks, Pete. Just to mention as well, obviously the FX component is going to be one of the largely impacted ones. First of all, given its size, given the exposure in terms of ownership in foreign investors, just referencing a paper that's been recently published by our parent organization, GFMA, on the impact of US T+1 towards the FX markets. So it estimates that 19.6% of securities are owned by foreign investors and 16% of the equities market. And within those percentages, we find out that almost 50%, I think the exact percentage is 48%, is under European investors' ownership. So that kind of clears the picture that roughly around 9% of US securities would be in European hands. Coming back again to one of the points raised by Susan, obviously you have to you have to bear in mind the cutoff time. So an accelerated window of settlement process will imply the review of the settlement transaction, the FX transaction related to the security trade. And obviously you can only action that FX transaction once the details of the corresponding security trade have been confirmed. And therefore that will mean that the different participants within the settlement chain will have to book the trade or confirm the trade either on T0 or no later than T+1. Coming back again to the topic of the different cutoff times, there may be implications. They are driven by local regulations, and also you have to bear in mind the element of the national holidays, which can play a part as well. And also, yes, so basically just to sum it up, there's going to be an increased demand in terms of FX liquidity management due to the reduced timing. There's going to have to be liquidity collateral requirements will have to be reviewed. The corresponding funding arrangements will have to be reviewed. And obviously, if it all happens, as Susan was saying, if you just get a seamless transaction being processed through CLS, then that's not going to represent a major issue. But whenever there is some operational processes and remediation works that need to be conducted, then that's when challenges can arise.
Thanks. The third element then is the sort of inventory management. Barney, what impact do you foresee on how firms will manage their inventory? I think you already maybe touched on possible impacts in the securities lending market.
Yeah, no, look, I think for me, I think as Sachin was kind of pointing to the fact that this is still a little bit of a work in progress, but ultimately, one of the core points is around the recalls process, which obviously is very manual today. It's not exactly a shining light of automation across the industry, and so we're trying to move something that's significantly faster than question marks about our ability to do that. But ultimately, part of the problem is obviously it's very manually intensive. We all keep different books and records, and also and inventory, to your point, or inventory kind of directories. And also, obviously, recalls can have multiple legs to them. So I think there's a lot of work going on to look at, first of all, how we actually can manage recalls, and as in the actual operational process, whether the 11:59 deadline is the right one. A lot of conversations around that, both not overlooking the US market and the Canadian markets, which are both very big lending markets, different models needing different conversations. But I think it's, there's a lot of conversation going on with the RMA and with CASLA in particular that are worth plugging into for anyone that's interested in those. I think for me, what the two pieces that come off the back of that, one is, Susan's point is a great one. I think that, what cannot be allowed to happen is that sec lending, people start standing away from sec lending, and as a result, we have a performance problem as a result. I think that there's an awful lot of people who are very much making sure that we come to the table and address this, but ultimately we need to be doing it quite quickly, so that basically concerns around liquidity, concerns around settlement risk, deterring people from lending stocks, deterring people from borrowing stocks can't happen, and as a result, so the performance drag can't materialize. So ultimately, you've got the actual key point around recalls, but then I think the second piece is just making sure that we all manage perceptions and kind of our ability to actually lend. The other point, just on inventory briefly, is there are slight changes to corporate actions as well in terms of alignments between effective dates and next dates. So, very much worth making sure, as I said at the beginning, that the asset servicing teams are aware of that, and ultimately static data and obviously all kind of securities lending activity that's impacted by that is all covered.
Thanks, Barney. John, anything to add on the back of that?
Yeah, actually, a couple of points. And I think something that will likely have an impact on inventory management is the start of the processing day in the US is going to shift. It's actually moving out. So if you think about it today, DTC generally starts processing transactions at around 8:30 p.m. on S-1 and produces output around 10:30 p.m. S-1. That's what we call our night cycle. That's going to shift. We're going to, in the T1 world, we're going to start the processing at around 11:30 p.m. S-1 and produce output around 1:30 a.m. on S. So a lot of firms use that output from the DTC night cycle to calculate segregation requirements, loan availability, borrow needs, and of course, recalls. So, there's been an awful lot of discussion about recalls in the US. Almost right from the beginning of this project, the industry has finally landed on 1159 on T for the recall to be issued with a 48-hour period to return those securities. So that's a tight window, certainly something that firms should be taking a look at. I think another area in terms of inventory, and Sachem kind of indicated some of these, some of the mismatches in settlement cycles for certain types of securities. So, ADRs and foreign ordinaries are going to have separate settlement cycles, duly listed securities, ETFs with foreign components. So all of these are going to be out of sync and are going to require some special hand-holding and some special attention to manage from an inventory perspective.
Thanks, John. I think you've touched on our next point there. We're kind of reintroducing misalignment on a global level, having kind of got used since 2017 of having alignment between major jurisdictions in North America, Europe, and APAC. So Emmanuel and then Sachin, very quickly, because we're running short of time. Do you want to maybe talk about some of the problems you foresee from that misalignment?
Well, I mean, you're right. We already touched a lot about the misalignment, but it's true that there is no exception in the rules for ADR or listed ETF. So if you talk about canceling an ADR, it means that the ADR will cancel on T+1 while the foreign securities will settle on T+2. So this is one misalignment that we have identified. We know that US securities are frequently multi-listed on many markets. So you can buy US securities on the Deutsche Börse exchange, and that will probably settle on a T+2 settlement cycle. While if the broker wants to sell it on the US market, it will settle on T+1. So another misalignment and possible shortage of securities for one day. We also have the same type of misalignment in terms of settlement, place of settlement with transaction that will settle with the ICSD, and if the other leg is on the DTC market. So, and to finish with that, settling ETF is an entirely different proposition from other securities due to their underlying securities, which can be international and therefore influenced by the time zone differences. So depending on the composition of the ETS, you may also think that you will have to handle different market holidays from securities across the number of markets and cross-border settlement that will add up on the complexity, and we need to take this into account. So, I mean, already a lot of question about different types of settlement, misalignment. This is something that is currently discussed among global custodians in various industry working group. There is no per se concrete solutions, but there are discussion, and we think about how to address this different place of settlement in the market.
Thank you. Sachin, anything to add? And I'm just noting a question in the chat asking if we think there'll be an impact on liquidity for ADRs and ETFs as a result of this misalignment.
I don't want to comment too much on liquidity impacts as a result of this. Clearly, there'll be some challenges to overcome. I think my colleagues have spoken quite extensively on the misalignment issues. Look, we have to also bear in mind that there are provisions under the SEC Rule 15C61, which is the actual T+1 rule, which does allow for different settlement cycles if agreed between the parties. So there are ways to alleviate some of those concerns. Not that we would advocate necessarily to go for settlement cycles longer than T+1, but there are possibilities there. But also other options are being explored right now is, potential capital relief treatment when it comes to the misalignment issues. Again, none of these are set in stone, so I think still one to wait and see. And the other one is looking at the buy-in risk. I think I mentioned it earlier. whether there's ways in which we can still have a buy-in risk covered on an ADR, for example, under the 204 rules, whilst having a conversion of an ORD taking place after 2 days. So maybe some timing relief there may be sought after. So I'll keep it pretty succinct because I know we also have another important question coming up.
Thanks, Sachin. So yeah, I think that leads into the question of whether Europe should also be moving to T+1 and reinstating that global harmonization. The perception has generally been that it's going to be a more challenging project in Europe. So maybe Pablo and then Susan in a minute or so each, could you share your thoughts on what AFME and the pharma and the rest of the European industry are doing and should be doing in this space?
Yeah, thank you, Pete. Sure. So obviously, that's a very hot topic out there in the market on whether Europe should follow the path of moving to T+1. And so first of all, I think it's important to recall that there's a number of important differences between both markets. With the EU being a much more fragmented, complex, with a number of different regulations, tax regimes, different CSDs on the 27 member states. So that would be one of the main points just to consider. Also within those differences, actually within the regulatory space, talking more specifically on the central securities depositories regulations, which following what Emmanuel was referring to, it imposes cash penalties on participants failing to settle transactions on its due intended settlement date. So, if current issues in terms of settlement efficiency on a T+1 settlement scenario with a more compressed time frame, those issues would just be exacerbated. Coming again to the point of CSDR, following today's recent agreement by the European co-legislators, it's been agreed that ESMA should produce a report with an impact assessment and submit it to the European Council and Parliament 1 year after the entry into force of the CSDR refit. So yeah, as I was saying, there's a number of structural differences that need to be deeply considered before thinking about moving to T+1. More specifically, within AFME and also partnering with other organizations, we've set up a market settlement efficiency task force, trying to understand what are the pain points, what are the blockers, which hurdle or provide, inefficiencies in terms of achieving optimum results of settlement, because we need to improve the settlement rates in Europe. And so far, we've been looking at more qualitative data, trying to understand what the different blockers are and are on the cusp of starting reviewing metrics and more quantitative data. And as well, just conscious of time, mentioning as well that with many other European associations, we are part of the industry-led EU T+1 task force. And within that task force, in terms of the outputs of the task force, so there's two separate work streams. The first one, which is more focused around of the US T+1 impact on European markets, for which we plan to publish a report highlighting the concerns, the challenges, and kind of to word out what are the perceived risks of such move. And then over the second half of this year, the task force will be working on our proper review on whether Europe should move to T+1, and with a number of subgroups with industry experts, for example, in terms of clearing, settlement, securities lending, or FX, or any of the topics that we've covered on this panel before.
Thanks, Pablo. Susan, you're also part of that industry work. Anything to add from the buy side view?
Yeah, so I feel like if I have to comment on EU T1, it's interconnected obviously with US T1, so I'll have to start there with my comments if I could. And I think that if there had been a more coordinated approach across jurisdictions, I think we'd probably have a more seamless and sort of less disruptive migration to T1. And if I look at the T+1 playbook, I don't know, I'm making up this figure, but I think it's 95%, it's 200-page long document, and I assume about 95% of it is domestic focused. But then if you consider that the US equity market is somewhere in the region of 1/3 owned by non-US investors, then I think there's a little bit of an imbalance as to how this issue was approached. In terms of what we end up doing and where the buy side sits here, I think that currently it's hard to say what the impact will be. From where we sit now, will there be an impact on capital flows once we're on US T+1? There may be, I don't know. It might be that there's no disruption and we just absorb the costs on the European side, on the Asian side. But again, it's a bit of a question mark. And then maybe final kind of thought to put out there. I think it's not very nice to be on the receiving end of something in that, if you look at what happened in the US, there was kind of this momentum and there was a kind of triggering event around GameStop for people to kind of coalesce around T+1. It's not the best policy making and change implementation when you're kind of faced with a fait accompli. So it feels a little bit like that. Sorry to be the whinging one, Pete, but there, I've done it.
There was a question in the chat asking for the benefits of T+1, which we don't have time to get into, but there are some. I think we talked about, it being a catalyst for automation. So we should mention that there could be positives from this experience as well. I'm afraid that's all we've got time for. There are more questions that we didn't get time to answer, but we'll do our best to include those responses in the write-up that will follow. That write-up will also include a link to register for our annual conference, Optic, taking place in person in Brussels on the 17th and 18th of October. And everyone who signed up for this webinar will receive a code offering 20% discount for Optic, where no doubt the T+1 conversation will continue. So all that remains then is for me to thank all of our expert speakers for being so generous with their time, and all of you who dialed in to hear us speak and joined in the debate. So look out for that write-up, including the details on how to register, and there'll be an opportunity to watch this back as well. So thank you, everyone, and goodbye.
Thank you.
Thank you.